Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Let's take a look at some of the stories we're tracking for you in the BNN Bloomberg newsroom. And CTV News is reporting Prime Minister Mark Carney will announce measures today to help Canadian steel producers and those in the softwood lumber sector. There are also multiple reports that more financial aid will be announced for both industries. The news comes as the steel, aluminum, and lumber sectors continue to deal with high tariffs imposed by U.S. President Donald Trump. Shares of Brookfield Asset Management are trading higher. They're up about 1% right now, a little under that. The asset manager, along with Singapore's wealth fund GIC, have offered to buy Sydney-listed National Storage REIT in a deal valued at more than $2.5 billion US. The Australian self-storage provider says it aims to strike a deal by December 7th. National Storage operates more than 270 storage locations across Australia and New Zealand. Blue Ant Media is buying Vancouver-based Thunderbird Entertainment. The cash and stock deal is valued at $89 million. It is expected to strengthen Blue Ant's studio business as well as its cash flow. Thunderbird's businesses include Atomic Cartoons and Great Pacific Media. The deal is expected to close in the first half of next year. And taking a look at the markets, the TSX continues to push into record territory. It's up another 0.6%. The rally continuing. South of the border, similar situation. That rally now extending nicely. You can see the S&P 500, the Dow, both up by 0.65, and the NASDAQ up by 0.7%. Bets the Fed will lower rates next month appear to be gaining traction, giving investors some confidence ahead of the American Thanksgiving. Add to that, Bloomberg has reported that Kevin Hassett has become the front runner in the race to replace Jerome Powell. For more on this, we were joined earlier by Carl Shimada, Chief Market Strategist at Corpay.
Clearly anticipating a more dovish, policy response from the Fed going forward. There's definitely the idea that Hassett will steer the committee toward delivering more rate cuts on a shorter timetable. But the reality here is that the Fed is a consensus-driven institution. It does require a majority of the committee to, approve a rate decision. And if anything, the White House appointing someone who's very clearly partisan and very clearly, sort of being put into the role on the basis of his loyalty to the president, that actually might mean that other committee members are a little bit more reticent to sort of, go with the flow. I think to some extent we might see, the economy really driving those decisions as opposed to the dovish impulses of Hassett himself next year.
And what is your take, Carl? Is the U.S. economy weakening decisively, or is it hanging in?
It's not decisive at this point. Clearly we're seeing a rolling over in consumer sentiment and indicators like that. On a soft basis, a lot of the indicators that you look at are telling us that consumers want to be more cautious, and that investors and businesses are also, sort of moving to the sidelines to some extent. But when we look at the hard data, virtually nothing is showing, a hard, decisive pivot in the economy. Reality is that consumers are still out there spending. If we look at higher frequency data releases, they're pointing to a year-over-year increase in retail spending, for example. Businesses are still investing. We're not seeing that sort of, that decisive or clear-cut evidence of the economy running into a wall. That being said, when we think about how the Fed is setting policy right now, they are thinking about this from a risk management standpoint. If you look at what a lot of the policymakers have been saying recently, they've been saying that if we see, labor market conditions soften a little bit, that could raise the risk of a non-linear downturn in labor markets and then across the rest of the economy. So they're inclined to deliver what they might characterize as a risk management cut as opposed to, this sort of aggressive easing campaign. And so, I think that the evidence is not there yet. But when we think about how the Fed is going to approach this, they're probably going to err on the side of caution. They're probably going to want to ease policy a little further, and then wait for next year when the real effects of this year's policy turmoil begin to show up.
Give us your thoughts on the British budget. Rachel Reeves, the Chancellor of the Exchequer, talking about £26 billion of tax increases. But there was chaos. A bunch of data got released early, and she's not happy about that.
No, I really can't blame her. It was chaos on trading desks around the world as well. The funny part was when the document was released by the Office for Budget Responsibility, I didn't know if it was real. I wasn't totally sure if it was a misprint, a reprint of something that had come out before. There was a lot of skepticism initially, and then it became clear that it really was an accidental release of what she was about to say. And it did cause a little bit of havoc, but when we look at what was laid out in the budget, it sort of aligns with what markets had anticipated. It does, point to a degree of fiscal discipline. The government is looking to avoid sort of an increase in indebtedness over time, an increase in borrowing. They are not pushing the limits as the Liz Truss administration did a few years ago. That has meant that the gilt market, that the pound itself have not moved all that dramatically. However, there is a bit of skepticism embedded in all of this, because if you look at how the budget is sort of temporally set up, we have a lot of spending coming through in the short run, and the tax increases kind of kicking in over a prolonged period of time. So it's like a front-loaded budget, right? We're familiar with these, of course, being here in Canada, but the reality is that markets, when they really look at this, are going to really say, well, how many of these projections are really going to be borne out in reality? What path is the UK on? And unfortunately, I think that at the end of the day, the UK's vulnerabilities are still going to remain on display.
In particular, their uncertain future in trade after they quit the European Union?
Yes, Brexit has certainly inflicted damage on the UK economy. There's no doubt that in the years since the referendum that the pound has traded lower, that trade relations have not remained on an even keel as much as they did before. But the bigger story, I think, is just a very simple one, and it's that the UK is running a twin deficit, right? They're running a very big fiscal deficit, as well as running a trade deficit. And so what this means is that on an ongoing basis, they need to attract foreign capital. They need to attract capital from the rest of the world, or get UK entities to give up some of their foreign holdings and bring them home. And so what this means is that you have sort of an ongoing vulnerability. Whenever there's a shock or a loss of confidence in the UK economy or in the government's fiscal stance, then we tend to see a lot of downward pressure placed on the pound. And so what this has meant is that the pound has consistently traded in a more volatile range than its counterpart across the channel. And that doesn't seem likely to lift anytime soon.
Our own Prime Minister, when he was head of the Bank of England, was outspoken in warning of the dire consequences of Brexit. He has his critics in Britain, people who are fans of leaving the EU. But have his concerns been borne out? I guess this is a thing that will play out over decades. Was it a bad move for Britain to leave the EU?
It's hard to say in the very, very long run how this will pan out. But, if we look at the efficiency of the economy, I would certainly say that this is sort of on par with what Trump is attempting to do with the U.S., right? The day that you put a lot of sand in the gears of international trade and international capital flows is the day that you make your economy less productive in the long run.
And Andy was speaking with Carl Shamata, Chief Market Strategist at Corpay. Up next, more Canadians are looking to buy homes this year, that according to RE/MAX. We'll talk about that with RE/MAX Canada's president after the break. more Canadians are looking to buy a home, including first-time home buyers. This, according to RE/MAX Canada. About a quarter of those interested would be ready to buy if the Bank of Canada cuts rates. Here to talk about these numbers is Don Kotick, president of RE/MAX Canada. Don, thanks very much for joining us.
Hey, Roger. Thanks for having me today.
Let's talk about the 10% of Canadians who are ready to buy a home or plan to buy a home over the next 12 months. That's I was looking about a 35% increase from the fall. What's driving that change, that optimism, I guess?
Well, I think we have to realize that Canadians have been living in a state of uncertainty in terms of the economic situation for the last little while, and as a result of that, I think consumers have just become comfortable that this is the way the things are going to work out. They had hoped that by this time the Canadian government had probably negotiated a settlement with the U.S. in terms of the tariff discussions, but that isn't the case, and so now they've just become comfortable with this state of uncertainty. And I think there's a lot of pent-up buyer demand that's existed in the market for quite some time, and it's just coming to fruition at this point in time going into 2026.
Now, it's a lot easier, of course, to buy your second home or your home after that, but about half of those people are going to be first-time buyers. Do we know the demographic breakdown on them? Are they younger? Are we starting to see young people again looking at buying?
Well, one of the things we're seeing that the first-time buyers, there's actually been a demographic shift probably in the last 5 years. We're starting to see that they're an older demographic. They're taking a little longer to save their money, kind of in light of the way things are at this point in time. And they, once again, they're skewing a little bit older than they had in the past.
So we're not seeing the young people, the optimism change for the young people. A lot of them still think they're not going to see a house for a while.
Well, I think anecdotally we're finding that home buying is still near and dear to all Canadians, and that includes the first-time buyers, the younger demographic. They definitely want to buy a home. That's one thing that our surveys had found. I just think that they're waiting a little bit longer than they have in the past. But they definitely know that, owning a home is one of the few ways that you can probably accumulate wealth in Canada in light of all the taxes that we pay here and things like that. So it is near and dear to our culture, and it continues to be a part of who we are.
And you have about 23% of Canadians say they're ready to buy if the Bank of Canada interest rates drop. What kind of a drop do they want to see before they're willing to get out there?
Well, it's interesting. I think that at this point in time, I do believe that right now the general consensus is that rates are probably going to hold firm for the Q1 and potentially into Q2 at this point in time, which is really creating that scenario that, okay, I'm not going to sit on the fence anymore. Rates have somewhat stabilized in a lot of consumers' minds. And so as a result of that, we're seeing these people that, wanted to sit on the sidelines, wait for that next drop to come. And now they realize that, well, it may not come for a while. This may be the way things are, and we're going to get back into the market. And so we're seeing that anticipation going into 2026.
And the numbers we're talking about, is it fairly consistent across the country, that percentage, or does it vary from region to region?
It varies. Obviously, everything is based on affordability. So the more affordable the markets are, obviously the uptick is going to be a little higher. The major markets like Vancouver and Toronto, where obviously the average price is higher, we're not seeing the same uptick than we'll see in affordable markets like Montreal, in Calgary, out in the prairies, Saskatoon as well too, and some of probably the rural regions across Ontario.
And when they do get out there looking, what kind of house prices are they going to be looking at? Have we seen a drop?
Yeah, I think what we're seeing is, going into next year, we're the general consensus is we're going to see probably a decline somewhere around, between 3% and 4%, probably closer to 4% in terms of average price across the country, and we anticipate though sales could be up 3.4% going into 2026. And so we're anticipating a slight upswing in the market. Once again, as people become uncomfortable with uncertainty.
And now we've seen a bit of a drop in immigration coming in. Is that alleviating some of the pressure for people looking for houses? A little less competition?
I think, Roger, like we're coming off, decades of chronic shortage of inventory relative to our population. So even though, they have reduced the immigration somewhat, we have increased immigration quite a bit in the past 10 years. So we're going to feel the residual effect of that, kind of record immigration that's come in the last few years. And once again, that's going to put pressure on the rental market, but also put the pressure on the conventional real estate market as well.
And just going back, you mentioned about tariffs. Has that had an impact other than almost a psychological one, but expense-wise, especially for new homes, have we seen an impact on that on house prices?
Well, I think one of the things that obviously there was concern in terms of the cost of materials and things like that impacting the homes. But from a consumer sentiment, I think that kind of, we had the initial shock probably back in February and in the spring when the impact was really felt. And as time has gone on, once again, people have just adjusted to that reality that, this is the way it is. And, people have just given up that a resolution is going to happen. And as a result of that, they jump back into the market.
Okay, we're going to have to end it there. Don, thanks very much for joining us, though.
My pleasure. Thanks, Roger. Thanks for having me.
Don Kotick is president of RE/MAX Canada. Coming up, shares of Deere & Company are down today as its 2026 net income forecast misses estimates. We'll unpack those numbers after the break. Well, shares of Deere & Company are down this morning despite a beat in profit and revenue as its 2026 net income forecast misses estimates. You can see it's off by more than 5% right now. Its CEO is predicting 2026 will be the bottom of the large agricultural cycle. Here to talk more about that is Stephen Volkman, equities analyst at Jefferies. Stephen, thank you very much for joining us.
Great. Glad to be here.
Before we talk about 2026, let's look back. The numbers you saw for this earnings report, what did you think? What did you think about them? Was there some things to like, or was it worrisome?
Yeah, I mean, it was fairly weak, to be honest. This is one of those situations where the sort of operating numbers were probably a bit of a disappointment, but they made it up with below the line items, which the market doesn't love. So I think that's part of what we're seeing today in terms of the stock reaction. They're sort of mired in a deep downturn in the agricultural markets that doesn't seem to be letting up. It's actually getting pushed into 2026 now, and that's really the full story here. And then I guess I would layer on a little bit of tariff pain as well. They're absorbing, a fair amount of cost on that front.
Okay, let's talk about their 2026 forecast. $4 billion reported. The estimates were 5.31. That's a pretty big difference between the two.
Yeah, absolutely. I mean, I think there was some cautious optimism that maybe 25 was the trough of the cycle. And I think you put it right. It's now sort of being pushed off into 2026. And so, that's mostly in the large agricultural end market. They actually have a little bit of growth forecasted for construction equipment and for small agriculture. So it's the large ag that continues to sort of be in that bottoming process, I guess.
And the CEO has said that he thinks 2026 will be the bottom. Does he have that reason for, I guess, optimism, if you want to call it that? What is dragging them down?
Yeah, right. I mean, to be fair, I guess they also thought 25 was going to be a bottom, and that turned out to get pushed out. It's hard to forecast that, so I'm not trying to throw shade on them there. But, we do have, we're 2 years into a downturn. That's about how long peak to trough tends to last historically. So we have that on our side. You've probably seen that crop prices, especially soy, have rallied a little bit with some cautious optimism more around a settlement with China. So that would be good news if it happened. And the company did stress on the conference call something we talk about quite a bit, which is that biofuels usage continues to improve, and that helps on the demand side for corn and soy. And so, hopefully that helps to normalize those markets as well. So I think there's reason to be cautiously optimistic, but, these things sort of have to come through.
And that big dispute with China, will we see any lag with that if it's settled, if it does end up being settled fairly quickly?
Not necessarily. Actually, China has already bought some U.S. soy, and they didn't do any of that until just a few weeks ago. So, that's a big change. And so I think if they do have a reasonably quick settlement there, we could see, trade resume fairly quickly.
And with the tariffs, what kind of an impact are they having? You mentioned it off the top there.
Yeah, I mean, in their guidance, they have about $1.2 billion of headwinds in 2026 from tariffs. It's not clear what they're doing in terms of timing relative to offsetting that. I think it's probably a bit of an all of the above approach. I think they're probably working on getting the supply chain kind of rejiggered for best cost. I think they're probably doing some productivity. They're doing a little bit of pricing as well. They expect pricing to be up modestly in both construction and in agriculture. And so, I think as we go through 2026, you'll see that improving, but it's certainly a headwind for the full year.
And are other companies seeing those similar headwinds? I'm just looking at, they're trailing Caterpillar. What's Caterpillar doing different?
Yeah, nothing really, to be honest. I mean, Cat is also seeing some of this headwind from tariffs. They've given some numbers around that. I think it's upwards of $3 a share for baked into kind of the forecast. So, I think this will be a process. I think these companies are wary of pushing through too much price too quickly because the rules are still changing, quite frankly, and you don't want to kind of overdo it if you don't have to. And so I think this will be a sort of a slow approach. Ultimately, I think they'll recapture it, but whether that happens in 26 or perhaps 27, I guess, is still to be seen.
And are there opportunities to be had? Do you see any for them?
Well, yeah, I mean, I do think the opportunity is if we're bumping along at the bottom of an ag cycle, we don't know exactly what will drive the upside, but it could be something as simple as perhaps the Brazilian crops are a little bit below expectations. We have a little bit less supply. That would help crop prices in the U.S., for example, and probably start the upcycle. As I mentioned earlier, biofuels blending could be up fairly dramatically in 26. We have seen California, for example, go from 10 to 15% blend of ethanol. That would be a nice tailwind if it happened across the country. And also, of course, biodiesel is made from soy. And so increases in blending there could also really help on the demand side. So, it does feel like we're bumping along a bottom. The valuations kind of reflect that, but we just don't have a lot of confidence in kind of when and how this goes back up again yet.
Okay, Stephen, thanks for joining us.
Great. Happy to be here. Cheers.
Stephen Volkman is equities analyst at Jefferies. When we come back, Urban Outfitters has reported record third quarter sales. What does it say about the retail sector as it heads into the so important holiday season? We'll take a closer look right after the break. Globe and Mail is reporting the Canadian Securities Exchange is considering buying CBOE Canada and CBOE Australia. The report says talks are preliminary and there's no guarantee a deal will emerge. According to the report, CBOE is selling its Canadian segment because it is realigning its portfolio of businesses to sharpen its strategic focus. Brookfield Asset Management, along with Singapore's wealth fund GIC, have offered to buy Sydney-listed National Storage REIT in a deal valued at more than $2.5 billion US. The Australian self-storage provider says it aims to strike a deal by December 7th. National Storage operates more than 270 facilities across Australia and New Zealand. Shares of Dell are moving higher, up almost 7% right now. The computer maker has raised its annual outlook for the artificial intelligence server market. The company says AI momentum has accelerated in the second half of the year, leading to an unprecedented number of orders. Dell is boosting its shipment projections for the year to $25 billion US. Investors see the move as a sign of sustained demand for Dell's machines amid the current data center boom. And looking at the markets, you can see the TSX well into record territory, and it is up again today by 0.6%. Another green day, and same for south of the border. The rally continues down there as well as they get ready to head into the Thanksgiving long weekend. S&P 500 up by 0.8%. Dow Jones almost 0.8%, and look at the NASDAQ up by 0.93%. Shares of Urban Outfitters are climbing today after the retail company reported strong Q3 earnings and an even stronger outlook for Q4. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya to talk about it. And big third quarter. We've seen a few of these now when it comes to retail. And the holiday season is upon us. Black Friday is upon us. What are they expecting?
Exactly. I mean, that's exactly what you mentioned. Like, we're seeing this a lot with retail, which is maybe not what people have expected given the state of the economy, both here and in the U.S. But yeah, for Urban Outfitters, the share price is absolutely soaring today. Last time I checked, it was up by about 10 to 16%, I believe. It was in 17% before. Now it's at 10%. You can see it was up 17% before the bell opened today. So really, the Q3 earnings report driving up that share price as well. Investors happy about this. So net sales beat estimates. Net income was up to $116 million US. Record sales of $1.5 billion. That's an increase of 12%. So both record sales, net income up from the year prior, of course, and the fourth quarter outlook, which we'll talk about in just a few minutes, also helped that share price to really go up. But as you mentioned, like, this follows positive results we've seen from many different retail companies, the Gap, Abercrombie, which also reported strong quarters as well as we've seen. When it comes to Urban Outfitters, important to remember, this is the owner also of Anthropologie and also the brand Free People. Women's denim really helped at Urban Outfitters. And when it came to the Anthropologie store, there's a new brand called Maeve, and that really helped with sales there too. But it's interesting to hear from executives within this company in that earnings call. The president and CEO was saying, although consumers are still waiting for sales, in the last quarter, what we really saw in terms of people buying things is they're okay with paying full price.
Full price, interesting.
Yeah, very interesting.
Which hopefully good sign for the economy. But I guess the next question is, what can we expect for the fourth quarter?
That's exactly it. I mean, when we're talking about the fourth quarter, there's a really positive outlook coming. Expect total sales to grow in the high single digits for the fourth quarter. Total revenue to also grow. Profit margin growth by 25 to 50 basis points. That's driven by lower profit margins. That includes growth at both Free People and Anthropologie as well. There's also something interesting that Urban Outfitters started a couple of years ago now, back in 2019. It's called Nuuly, and it's a business side of their business, obviously, that's like you subscribe to it and then you can rent clothing from it. Like you can rent a certain amount of clothing a month. Yeah, Nuuly. And this is really to appeal to the younger side, the Gen Z shoppers. Apparently, according to executives on this call last night, it's doing really well. It's bringing in younger shoppers, that Gen Z base. But Nuuly is actually expected to deliver mid to double digit revenue for the fourth quarter. So that is one side that it apparently is doing very well.
Okay. Yeah. Renting clothes. Who knew? All right, Lindsay, thank you for that. BNN Bloomberg's Lindsay Biscaya. Taking a look at some of the top gainers on the TSX this year, Aris Mining is in third place with the stock up 266% since the start of the year. We sat down earlier with Neil Woodyer, CEO of Aris, to discuss the strategy going forward.
We started 4 years ago. We've acquired 2 mines, and we're now this year producing about 250,000 ounces. We're expanding both mines. We've expanded our Segovia mine, which produces 200,000, the production facility, and over the next year, we'll ramp it up to 300,000. We're also expanding our Marmato mine by building an industrial mine below the small mine that we have, and that will take us to just over 200,000. We expect to have the first gold pour towards the end of next year. So in total, in a year or so's time, we'll be at 500,000 ounces. And we have 2 additional projects, one in Guyana and one in Colombia, which if we were able to put that into production over the next few years, in fact, gives us a very clear road to 1 million ounces from our own resources.
How many years could that take to get to 1 million ounces a year, roughly?
I think by the time we have Soto Norte permitted, 2.5 years, 2.5 years to build, 5 years order of magnitude.
Now, you got in a tangle with Colombia. You took a dispute to arbitration. That's now settled. What was that all about?
Well, it was started by our predecessors who were complaining to the government they weren't helping them get access to part of their tenement above the current mine at Marmato, the upper mine. Also that they weren't getting the security that they should get from the government at Segovia. So they sued the government 2018 for $350 million. After we took over Gran Colombia a couple of years ago, I came to the view that it's probably not best to be suing your host government. And even if you won, you probably wouldn't get $350 million from the government. You would probably get a lot of negative press. So the best thing for us to do was to negotiate and find a compromise where we could work with the government. So over the last 2 years, we've done that. We now have an agreement with the Ministry of Mines, with the regulatory authority, to help us formalise the area above our present mine and take production into our mine. In addition to that, we have arrangements with the Army and the Navy to improve the security around Segovia. So we achieved what we wanted to achieve without any cash transferring, and also we obtained very, very much goodwill from the government in doing so. This was the first arbitration they've successfully gone into, and I think it's improved our relationship, which will help us in the future.
You mentioned security. What is the challenge there? Is there pharmaceutical activity in the area, for example?
No, it's a relatively benign area. There is some illegal mining on our site and our areas, so we have to clean that up. The really bad guys are far away from us, so that's not too bad. So it is really just improving the day-to-day security, because at $4,000 gold, it's very easy for people to decide to go in and pick some themselves.
That's interesting, yeah. I mean, it's not unknown in Mexico for gold production to be stolen at mines. That's interesting, yeah.
Well, in Colombia, I think one of the interesting things is it's a country of huge gold potential. Only 15% of it comes through formalized industrial mines. 85% is small miners. There are 350,000 small miners operating in Colombia. So Colombia is ranked at about the world's 50th producer. But if you included all that, you get to around about number 10. So it is a significant gold producer. It is just very informal, small mines, low-level industrialization, which is our potential.
It's interesting. I remember reading years ago in Colombia, these informal miners, they'll detect some rich gold. They'll just get a backhoe and dig it up.
Yeah, some of them are a bit more sophisticated than that, but the issue is there's no clean processing. When they process, two things happen. They've got to get rid of the tailings and the damage that they do. And the second thing is they only get about 45 to 50% recovery, whereas we get 95% recovery. So if we could work with them, which is what Aris has started to do, it significantly improves the dollars coming out of the gold. So we have more to share with them, and we formed these partnerships with them, which have given us tremendous support in the community and really enhance our license. And also fall in line with the current political thinking of the government, which is the formalization of miners. And that's exactly what we've been doing, using our processing, working in true partnership with them.
Yeah, I guess I'm not sure if this happens in Colombia, but they use the informal miners. They use terrible things to refine the gold, don't they? Mercury and arsenic, and it's a health hazard.
It's not only a health hazard; it reduces their lives too. So yes, we can clean that. We've cleaned a lot of that up, and that's why we're attractive. We can take these illegal miners who are part of the black economy to be real businessmen operating with us, paying their taxes, getting the social services, and being totally legitimate, and not under any pressures that, from anybody who would like to take advantage of them.
Just talk to us about this Soto Norte asset. You just took 100% control of it. What is that? How big could it be?
Soto Norte is a huge gold deposit. It was originally built up by Ike Batista. Mubadala went in and lent him $1.2 billion. They spent a lot of money on it. They subsequently owned it. They had designed an absolutely huge mine, which failed to get environmental approval. So a couple of years ago, we persuaded them to sell us 20% and let us manage it. And as a result of that, we were able to determine that the mine they were building was totally inappropriate, they're trying to build. It was just too large. It had too many risks. It was too strong in front of the environment, too strong in front of the community, and it had a lot of community objections. So we've reshaped it, reformalized it. We're talking of a mine about half the size, much smaller environmental footprint. The tailings facility is about 40% of the original, relocated. They were going to build a 7.5-kilometer tunnel between two mountains. And the idea of a tunnel boring machine on top of the Andes is kind of risky. So we've resized it, re-risked it, got a lot of community support because we've taken people from the area to our mine at Segovia, where we're working with the small miners, and said we can do this the same thing. In fact, we've designed the mine and we intend to build something 120% of the capacity that we need. So we'll have 20% capacity available for partner small miners that we can create to work with in the community. So a very much reshaped mine. And as a result of that, we were able to negotiate some time ago that we got up to 50%. And I was able last week to negotiate the additional 49%, which now gives us 100% of the mine.
You've been around for a while, haven't you, Neil? You were founder and CEO of Lee Gold Mining and Endeavour Mining. Endeavour Mining, huge now in West Africa. After Aris Mining, well, what are your plans? If you sell Aris Mining, I don't know if you will, but will that be it, or will you get into another gold startup?
Well, I must be honest, I'm 82, so this is probably my last go, so I'm really enjoying it. Now, I think when I think back to how we dealt with the two companies, we built Endeavour up over a 5 or 6 year period, and I think it was about 500,000 ounces when we left. It's now 1.1, so they've done a fantastic job. That's what I'd like to see at Aris. Leah Gold, I think with reflection, I put it into Equinox too soon. I should have taken it to the next step. Here we now have 250,000, expanding, fully financed to 500,000, and we have very concrete plans from our own assets to take us up to the million. That is where we determined to go, and hope we're allowed to go there as a management team. At that time, it's probably time for me to walk away and perhaps retire. So I'd like to see it continue on life with a change of management style.
Andy was speaking with Neil Woodyer, CEO of Aris Mining. Coming up after the break, a Bay Street analyst cuts his rating on 2 Canadian banks. We'll get more on that after the break. A Bay Street analyst has downgraded his rating on Canadian banks RBC and TD Bank to hold. This means he now has no buy ratings on any of the Canadian bank stocks. Let's get more on this from the man himself, John Aiken, research analyst at Jefferies. John, thanks very much for joining us.
My pleasure. Thank you for having me.
Let's start to talk about the individual banks first. RBC, what brought about the change?
Well, it actually is the same reason for both. We do think the valuations are fully reflective of the outlook, and basically we do think that the dynamics are that if there's any ripple on credit, there's more downside risk than upside. Royal, we still really like the fundamentals of the bank. It's well diversified, it's best in class, and but right now is that as we've seen over the fall, over the last 3 months, that it's really being bid up to a point that we think that the valuations are a bit stretched at this stage in the game. Like Royal is at or just within its peak PE multiple on a forward basis, and so basically, we see a little bit of upside in terms of if they report a strong fourth quarter, but to generate another 10-15% will be very difficult unless there's any major change in the macroeconomic outlook.
Now the earnings are coming out next week. Why not wait till then and see the earnings first?
Well, we think that the fourth quarter earnings are going to be solid, but realistically, the areas that they're likely to basically have some tailwinds in terms of strong capital markets, strong wealth management, it's very well understood in the marketplace, and we think that it is priced in. Where the downside risk could exist is on credit, although we don't think it's necessarily going to be weak in the fourth quarter, but also expenses usually tick up in the fourth quarter. When we take a look at the balance of probability, as also where the valuation is, we can't recommend investors investors going into Royal at this stage of the game because we do see limited upside. We do see a positive, but it's not 15, 20%.
And with credit, you mentioned concerns with credit. How big a concern? Where are you looking with that?
In the fourth quarter, not that much. We haven't seen that much disruption in the economy. We've only seen unemployment levels tick up a little bit. So we do think that the provisions relating to impaired loans are going to increase. But again, that's being broadly expected. When we take a look at where Royal and the rest of the banks are trading at right now, we do think that investors have a very, very optimistic outlook in terms of where credit will perform in 2026. We're not there yet. We still see headwinds in terms of the economic growth, potential headwinds in terms of unemployment levels, and we do think that basically things are probably going to get a little bit worse on credit before they get better. We do think the second half of 2026 will probably be reasonably solid and could then start to see some valuation lift. But we do think there's probably going to be some pressure before we hit that point.
And what are your concerns with the headwinds with economic growth first?
Well, basically, we still do not have any resolution in terms of trade with the U.S. We also have the USMCA agreement being up for negotiation next year, based on the way that Trump and Carney have been not negotiating. You can't say that it's going to be smooth sailing on that. Any disruption on trade is going to cause additional headwinds in terms of economic growth, and then that just ripples through in terms of the credit outlook for the Canadian banks. If we do start to see increase in unemployment levels, that really is the canary in the coal mine for Canadian banks when it comes to credit. And then you could see a dramatic reversal in terms of sentiment. Again, the Canadian banks are very, very well run, very stable operations, but just right now with the valuation set, the balance of probabilities is there's probably more pressure than there is uplift.
Have you ever had a time where you had no buy ratings on any of the banks?
Not that I can recall. This is not a very comfortable position for me at this stage in the game. But that being said, when we look at the outlook for the Canadian banks versus some of the other sectors that we cover, like the insurers, they're not as stretched in terms of valuation, and as well, generally speaking, the life cos have more exposure outside of Canada than they do in. And our outlook is that Canada is probably going to face more macroeconomic pressure than the U.S. and maybe broader in the world.
And looking ahead, what might convince you to change to buy again?
Yeah, well, it would actually be basically stronger economic growth is really the key fundamental that we're looking for right now. That growth can hide a whole bunch of ills. It can even offset maybe an uptick on unemployment levels. But right now, we're just not convinced that we're going to see that acceleration in the near term. As well, the one thing that we're a little bit disappointed with the Canadian banks wholesale is return to capital to shareholders. They have exceptionally strong capital levels, and even though I'm concerned about the relative outlook for the macroeconomic environment, we do think that they're overcapitalized, and we would much rather see stronger shareholder buybacks in terms of lifting not just the EPS, but also be accretive to ROE.
Okay, and just one last question. Any names to watch?
For the quarter in particular, we recommend that investors focus on National Bank. Management has stated they are planning on giving us some estimates in terms of the additional synergies that they're going to get from the Canadian Western Bank integration. But more importantly, as they migrate Canadian Western Bank's portfolios onto their own, they're going to get capital relief. And we do believe that most, if not all of that capital is going to return to shareholders eventually over the next 12 to 18 months. That will be definitely a positive catalyst for sentiment on National.
Okay, we'll leave it on that note there. John, thanks very much for joining us.
Thank you.
John Aiken is research analyst at Jefferies LLC. Coming up, we'll check in on the trading day on Bay Street and Wall Street, see how things are going. Market calls coming up next, and today on the show we have Martin Cobb, Senior Vice President, Equities at Lorne Steinberg Wealth Management. His focus, U.S. and Canadian equities. All right, let's take a look and see how the markets are doing on Bay Street and Wall Street. It is another good day. You can see it's at the record high, up 31,100, over 31,100, and up by 0.66%. Moving the markets right now, we're just taking a quick look at that, was materials is up by 2.33, and those ones are, it's all gold and silver pretty much at the top. In fact, it is everything for the best performers right now are all gold, silver, and Hudbay is up there as well. Aya Gold is up by 8.8%, Discovery Silver up as well. So it is leading the way, the composite index. And then taking a look over on Wall Street, and let's see how things are shaping up there. It's another good day there. The rebound continues and the rally continues. S&P 500 up almost 1%. Dow Jones up by 0.9%. And the NASDAQ up by more than 1% as well. A couple of names of note. John Deere had that disappointing outlook. The farm recovery in the U.S., still concerns about that. It looks like that may last into 2026. Right now, John Deere's up by 5.54% on that. And taking a look, another one that had a good earnings report was Urban Outfitters, and people are responding to that. It is up by 10%, and as they head into Black Friday, the holiday long weekend in the U.S. as well. Of course, the markets will be closed tomorrow. Thanks for watching Morning Markets. We'll see you back here tomorrow.